Hey guys, and welcome to the Graham Strategy channel. A quick reminder to start with, I'm not a financial advisor and I do not make any recommendations on what you should or should not buy or sell. Since my last video, we've seen a great recovery in the market. The OMX index is up 11.33%, and there's a lot of positivity in media about the future economy. The Graham portfolio has gained only 9.7% over the same period, thus lagging a little bit behind the OMX 30, but still not too bad. And looking at the period since the start, we can see that the Graham portfolio has gained 54.57%. And there are some indications of a coming recession or a weaker economy. Sweden is already in a recession, but the US and many other countries seem to be able to maintain a positive growth and avoid a recession. A classical indicator of a coming recession is an increased unemployment rate. And looking at Sweden, the unemployment has increased slowly the past year and is soon back at pandemic levels. So it's no shocker that we're already in a recession here in Sweden. The US labor market, on the other hand, is quite strong, even though a tendency to an increased unemployment can be seen. You can also see it down here. We have a longer period. And zooming out a little bit to see an even longer period, we can see that the behavior now is very similar to what we saw before at least the last 3 to 4 recessions, especially if you ignore the big spike during the pandemic. So we can see here just before the gray bars here, which indicate the recessions, the unemployment rate tended to increase. Another popular indicator of a coming recession is an inverted yield curve. As you see here to the left, you see that the yield curve, and it is inverted. And it has been inverted for quite some time now, almost a year, but still no recession has hit the United States. However, something interesting has been observed the last 2 months, and that is a falling value of the 30-year Treasury, which makes the yield curve even more strongly inverted than before. Looking at the inflation, we can see that it's decreasing both in Sweden and in the United States. Currently, the KPI in Sweden is 6.5%, while the KPIF, which excludes effects of interest rates, is at 4.2%, and it is this measure that the Swedish central bank wants to reach 2%. The US CPI is at 3.2%, while the core inflation in October was 4.03%, and this is the value the Fed looks at when deciding whether or not to change the Fed's rate. Most people are speculating about the central banks will start to lower interest rates around spring next year as the inflation rates are getting close to the target values. And for most people, this is very welcome as this will affect the interest rates on mortgages. But looking historically, the reduction in interest rates has almost always been accompanied by a recession and a falling stock market. You can see that all the recessions have been timed with the falling interest rates, either just before or when it has already occurred. The blue line is the Fed's rate, and the gray vertical bars are the recessions. But perhaps this time is different, and we will have to wait and see. So that was all for today. Stay tuned for updates on the portfolio, subscribe, and hit the notification bell to receive a reminder when I release a new video. So until next time, as always, stay sharp and follow your passion.